Here to go out on that limb is Sri-Kumar, the president of Sri-Kumar Global Strategies. Sri, it's great to have you back.
Good to be back, Kelly. And yes, I am going out on a limb and on a record day to be talking about a 10% correction coming by the end of the year. But the various macro factors that I'm looking at seems to suggest that there is no way this situation can continue. What are they? We are looking at truce, in a sense, in three different areas. One is the Iran and Israel war. The second is truce on tariffs, and then truce with respect to the fiscal deficit, the big, beautiful bill. You have one uneasy truce taking place in the Middle East, but the other two are still basically unknown where they are going to go. You're going to have a pickup in the rate of inflation, as Jerome Powell has said yesterday and today. And I think that is going to be reflected during the second half of this year with yields going up. That is going to be negative for NASDAQ in particular. And I think S&P is not going to be free from that being attacked by that either.
So there was also interesting, we talked to Brian Reynolds last hour, who said he watches corporate tax receipts and says those were down significantly in the quarter, which could be a warning sign for earnings, could even be a problem for government revenues, but thinks prices will ultimately keep going higher because of stock buyback. So I wonder if you think that we're going to actually go from all of this excitement over being back to all-time highs to a little bit of a reality check in earnings season that, yeah, those tariff revenues are coming out of corporate profits.
Yeah, I think one element of the reality check, Kelly, is, as you said, what is happening with corporate earnings not being as strong as they used to be. But the second is also the macroeconomic influences, which are also going to be negative. And that, I think, is not being taken into account by the market. And if you look at what is happening to the 10-year yield, which you want to read side by side with the S&P 500 and NASDAQ, is that they have not shared the optimism that you see in equities. And while yields have come down some, we are still in the 435, 440 range.
But you know where we are seeing optimism in the credit markets? And I think it was Rick Santelli who pointed this out earlier today, high yield. You know, so it'd be one thing if you said, OK, the stock market is all because of higher prices and buybacks, and that's fine. But when you see high yield, junk credit, all of those kinds of things also performing well, doesn't that tell you? Goldman had a note out this morning saying even the subprime consumer is holding up better than they expected. Maybe the fundamentals are just stronger than where we thought we'd be. You
mentioned high yield. I think it's a very good point. The reason being high yield is where you take an additional amount of risk that you do not take in U.S. Treasuries. U.S. Treasuries, all the risk you take, despite all the downgrades that we have had, the risk you're taking is duration risk. You're not taking a credit risk. But high yield in that sense, even though it's fixed income, it's comparable to equities. And it is somewhere where you take a higher level of risk. So I think I can understand why high yield is doing well, even if you have caution in terms of fixed income.
When Leslie was breaking the news on the bank loan requirements, I saw you very keenly looking at the screen. Sort of, there's a lot, that's a complicated. It's a complicated issue. So what does that mean?
What it means, and I think there have been a lot of champions in the government, in the administration, that if that was done, there will be more of buying of treasuries by the banks as a result of the freed up reserves. Now, the question is, what do the banks do with it? Do they buy treasuries? Do they do something else in terms of the cash that is on hand? But the expectation is some of the money flowing to treasuries is going to bring down yields and will bring down the debt service cost, which is, I think, one reason why the administration is supportive of it. The other side of it, Brian, is when you do that, you also are reducing the amount of control that you have on the banking system. When the Federal Reserve does that and allows the banks, let's look at the extreme. Let's go to the extreme where you don't have much reserves at all. Then there is no way in which you can pull and push in terms of the central bank wanting to stimulate or cut back. Here, I think they are losing a point of leverage by doing what they have done. And it seems to me it was largely prompted by the need to counter the fiscal deficit and how to finance it at a reasonable cost.